Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns, and today I'm joined by my rotating co-host, Scott Lindsay. Scott, welcome to the pod.
Glad to be here, Jason. Always a fun day when I get to ride co-pilot with you on In the Harbor.
And today's episode is a special one. We're joined by a global economist who needs no introduction, but I'll introduce him anyways, Dr. Nouriel Roubini.
Definitely a fascinating history to this man, from his early days studying economics to academia and then shaping policy with Timothy Geithner and Janet Yellen. Dr. Roubini's career has spanned academia, government, and markets.
You may know him from his prescient call on the 2008 financial crisis, but he's also a long-term thinker with deep insight into how global megatrends are reshaping the economy.
Today, he's the co-founder, chief economist, and portfolio manager at Atlas Capital, and his latest work is far from what you might expect.
In fact, we'll hear his base case for the U.S. hitting 4% growth by 2030, driven by a new wave of productivity and innovation.
We'll also break down what that means for investors and how to think about positioning portfolios in a world of shifting risks and evolving opportunities.
It's a big picture conversation with practical takeaways. This is In the Harbor.
Dr. Roubini, it's great to have you here on the In the Harbor podcast. Welcome.
Such a pleasure being with both of you today. Thank you for
such a storied career and background. We thought we would jump right in. I think one of the interesting things we want to find out a little bit more about you is what was the drive that brought you and drew you into economics?
Interesting question. Well, I grew up in Italy, but actually I was born in Turkey, and my parents are Persian Jews. So went from Istanbul to Tehran to Tel Aviv, and then by the age of 5, I moved to Milano. And when I was in my teens, I started becoming socially and politically aware. I was only a 14-year-old kid, but in Italy, you had the social and political turmoil. There were terrorism, there was violence, there were, pushes against income and wealth inequality. And in the 70s, there were two major events. One was the Yom Kippur War between Israel and the Arab states that led to the oil shock and the stagflation of 73, 75. And then the Iranian Revolution that led to another oil shock and another bout of stagflation. So it was both local economic and social issues. And then there were the global ones, like the Yom Kippur War and the Iranian Revolution. And, being Jewish, being of Persian origin, knowing and understanding the Middle East, I understood that there was a nexus between economic issues, social issues, and geopolitical ones. And maybe I was not smart enough to become a real hard scientist, like a physicist or something like this. And the other social sciences like sociology or political science were a bit too soft. So economics to me was one way of understanding a little more rigorously this world, and also not just knowing in theory, but also to change it. I knew from early on that I wanted to become an economist. Literally by age of 16, I decided to study economics. And I wanted just not to become an academic, but I wanted at some point to be involved into policy, because I didn't want just to stay in the ivory tower. I thought economics is a tool to change society, economics, and make people better off, both in your own country and then globally. So there was this interest also to change the world for the better, not just to be a researcher or an academic.
And so when we think about that, and I think there were some Italian economists that went to Cambridge, right? So you went to a different Cambridge when you went to Harvard to study economics. Did that, following some of the Italian economists of the day, did that kind of help form your worldview?
Well, there were two Cambridges, one Cambridge UK and Cambridge Mass. In the 60s and 70s, a number of Italians went to Cambridge UK because there were these neo-Marxian economic taught schools. Sraffa was a neo-Marxist economist that was leading in the UK and was attracting many Italians. But, I understood the importance of Karl Marx to understand how history and economics connect to each other, but I was not convinced by the policy implications, even if at that time I would say I was left of the center in terms of my own economic and social and political views. While Cambridge, Mass, between Harvard and MIT was the place where you could study more rigorous, I would say, neoclassical economic theory and applied ones. And I knew I would study first as in college in Italy at Bocconi University with the idea of going to get a graduate degree in the United States. So Cambridge, Mass, rather than Cambridge, UK. And that's where I got my graduate education.
So let's talk a little bit about some of your early research, because I think it's very topical even today when we think about political dynamics affecting economic outcomes.
Yes, when I did my PhD, and my main advisors were Jeffrey Sachs and Larry Summers, I did some work that was on global economic policy coordination of monetary and fiscal policy. But one of my classmates at Harvard, a year ahead of me, was Alberto Alesina, who had written a number of papers about the theory of political business cycles, both electoral one and partisan, meaning what happens before elections and what are the different economic policies of center-left and center-right governments. And then with my advisor, Jeffrey Sachs, I wrote a couple of empirical papers testing whether looking at advanced economies, the business cycle were more driven by elections or by partisan differences. And the answer was a bit of both. And while my main, essentially, PhD thesis was on global macroeconomic coordination and spillovers of policies across countries, there was also a chapter about the empirical evidence on political business cycles. And then with Alberto Alesina, that then became eventually professor at Harvard. A few years later, we wrote a book around 2004 and 5 about political cycles and the economy, looking both at the theory and the empirical evidence about how much politics affects the economic cycle, meaning traditionally, whether you are center-right or center-left, before election, you want to try to affect fiscal and monetary policy to ease economic condition, to have stronger growth, to win the election. And that happens whether you're center-right or center-left. But then there are also differences in the macroeconomic policies between center-right and center-left. If you believe in a trade-off between inflation and growth or unemployment, center-left governments historically care more about jobs and growth, and maybe at the cost of slightly higher inflation, while center-right governments tend to prefer to having lower inflation, even if at the cost of slightly lower economic growth. And when you look at advanced economies, the evidence between the 1960s and 2000, early 2000, when we had the data and published the book, suggests that there were both electoral cycles and partisan cycles as well. So part of my research early on was also to understand also politics and the relation between politics and economics, and between macroeconomic policies and politics, and in part also geopolitics.
So let's connect that, because you talked early on about, not just being in the ivory tower and actually having, a hand in policy. So you've spent time at the IMF, the World Bank, you were at Treasury with Timothy Geithner, the White House with Janet Yellen. How has that kind of informed some of your thoughts?
Well, as I said, from early on, I didn't want to be just an ivory tower economist. I believe that economics has to be used for changing the world for the better. When I was already in grad school at Harvard, I spent summers as a summer intern at the IMF, and later on visited, the Fed, the World Bank, and so on. And then in 1998, I had the chance of serving in the Council of Economic Advisor of the White House when Janet Yellen was the chair. This was before she became Fed chair and then Secretary of the Treasury. And then a year later, when Larry Summers, my former advisor at Harvard, became Secretary of the Treasury, I moved from the White House to Treasury and was formerly the senior advisor to Tim Geithner, who at that time was the Undersecretary for International Affairs. So I knew that eventually I'd end up formally doing policy work. And those were interesting years. It was between 98 and 2000. It was the East Asian financial crisis, and I'd become an expert of it by writing some of the seminal papers in 97 on why these countries like Korea, Thailand, Indonesia, Malaysia went belly up suddenly, what was driving those financial and economic crises. So my expertise of crisis started with the Asian financial crisis, but then that crisis became global. By the summer of 98, when I joined the White House, you had the collapse of Russia with the default. And there were worries. We were having meetings in the basement of the White House in the Situation Room, literally because we were worried about the collapse of Russia leading to dangerous things with the nuclear weapons. So that was really scary, scary times. And then from Russia spilled over to LTCM and the collapse of the biggest and most leveraged hedge fund in the US. And then that became a contagion that then led the Fed to cut rates. And then the spillovers went to Brazil, Argentina, Turkey, and so on. So I wrote at that time chapters of the economic report of the president about the Asian and emerging markets and the global financial crisis, what caused it, and all the work we did about crisis prevention and crisis resolution. This is the time where we design, for example, tools to restructure bonded debt. Before the Asian financial crisis, most of the crisis of the 70s was syndicated loans to emerging markets. That was easy to restructure because you put in a room 40 banks and you tell them, get a deal. But when you had thousands of bondholders and you want to restructure the debt of an emerging market like Pakistan or Argentina or you name it, how do you do that? We created tools that are exchange offers that allow you to essentially corral even thousands of different investors by doing exchange offers. So we created actually mechanisms for not just crisis prevention, but also for crisis resolution, restructuring of private and public, domestic and foreign debts of countries that get in trouble. So it was really redesigning the entire architecture of debt crisis and debt restructuring between 98 and 2000.
What's really interesting is as we fast forward now 25 years, a lot of those themes are back front and center again today between debt, dysfunction, and fragility. Maybe now, Jason, we can dovetail in a little bit about Dr. Roubini's latest work and how we're seeing those themes roll through again.
Yes, and that comes to the book you wrote in 2022, Megathreats, and I read through it, and I actually enjoyed a lot of it. You know, and even though it's talking about things we should be concerned about and things that should be top of mind, I think what a lot of listeners will find interesting is you actually quoted Yogi Berra in the book, which I thought was a yogiism that was great. And it was, I think it's difficult to predict the future, or it's difficult to make predictions, especially the future.
Yes, as a joke, he said, it's hard to forecast things, especially about the future. There's the other joke that God created economists to make weathermen, astrologers look good when it comes to predicting the futures, because the economists have a dismal track record of predicting changes in economic activity or crisis. I seem to be an exception just because of a specialty on financial crisis. And after the global financial crisis, I wrote my first trade book titled Crisis Economics. Yes, you know, in the book Megathreats, actually, the first two chapters are exactly about unsustainable debts. And chapter one is titled The Mother of All Debt Crisis, where I point out there has been a build-up for the last few decades of both private and public debt, domestic and foreign debt, and within the private debt, debt of households, debts of corporates, debts of traditional financial institutions like banks, and debt also of non-bank financial institutions, what people now refer to as shadow banks. And this buildup of debt has led to a series of debt crises. Initially, it was more a story of many emerging market crises. And in 2005, I wrote a whole book after my experience in Washington titled Bailouts versus Bail-ins, how to resolve financial crises in emerging markets. So all my work that I've done between academic research, policy, and empirical led me to writing about financial crisis in emerging markets. But then those crises have now spilled over also, in advanced economies. When that became unsustainable, we saw Greece going into a crisis and having to restructure its public debt. There were massive pressures after the global financial crisis in Italy. More recently, the fiscal problems of France have led to pressures coming from the markets. And I would say the most interesting recent example, what happened in the UK, Liz Truss did not survive for more than 44 days because she did a fiscal stimulus between cutting taxes, spending more than the market did not like. The bond yield went through the roof. The currency collapsed. The pension funds, some of them had mismatches and went into a crisis. And she lost power after 44 days. So the most powerful people in the world are literally the bond vigilantes or the market vigilantes. We can punish countries that have loose fiscal or monetary or other types of macro policies. When I was the Clinton White House, one of the main advisors of Clinton was Jim Carville. And he said two things that were memorable. The first one is, it's the economy stupid, meaning if you really screw up the economy, voters are going to punish you. And one of the reasons why the Democrats lost the last election, among others, was the spurt of inflation that occurred after COVID. But the second thing he said was, he said that if there is reincarnation, I don't want to be reborn as the Pope or the President of the United States, allegedly the two most powerful people in the world. He said, I want to be reborn as the bond market, so I can go around and intimidate anybody, meaning the bond vigilantes. And we've seen it actually in the last few weeks, right? Trump started to do policy that would be stagflationary, causing more inflation, tariff, protectionism, restriction to migration, trying to meddle with the independence of the Fed, trying to have unsustainable fiscal deficits. Bond yields went higher, stock market fell, credit spreads widened, 100 basis points for high yield. The dollar fell, and then he had to blink. And I said in November, after the election, I wrote a piece and said, there may be policies that are good for growth and reduce inflation. There'll be policies that are going to reduce growth and increase inflation, but it's going to be boxed in by many forces, starting with market discipline, the bond vigilantes. That's why I predicted this cycle of talo and taco. Trump always lashes out, but when he lashes out, the market punishes him. And then when the market punishes him, Trump always chickens out, taco. And then he feels like he's a wimp and he has to lash again to pretend that he has credibility. And then you have another cycle of talo followed by market discipline and taco. And initially the markets were overreacting to him lashing out. And then when there was relief and he chickened out, there were also relief. I think people have learned that this cycle is going on over and over again. So in the last few weeks, I think markets are reacting less to his lashing out, and therefore they are relieved less when he then chickens out because they know this is happening. So people try to absorb those kind of things as well. But definitely market discipline is one of the most powerful forces, even in the United States. That is the global reserve currency, because we run large fiscal and current account deficits. And if bond yields were to go much higher, then you could have a recession.
Well, and I
higher
think
bond yields, everything's more expensive. Mortgages, borrowing by the private sector, high yield, high grade, auto loans, student loans, credit cards, you name it. So the bond market is the real vigilante.
Well, and I think going back to what Carville said, it's the economy stupid, but that also translates to midterm elections. And you can be boxed in by midterm elections because of the political environment we're in.
Yes, and that's why after April 2nd, when everybody on the sell side, starting with JP Morgan and Goldman Sachs, said we're going to have for sure a US and global recession, I said no. Usually I'm contrarian because I'm more pessimistic than consensus and the conventional wisdom. This time around was the opposite. Everybody said we'll have a US and global recession, but right after the election, I wrote this piece and said he has stagflationary policies, but it's going to be boxed in and guardrailed by market discipline by Fed independents, by some good economic advisors like Scott Bessent and Steve Mirano. Of course, there are the crazies like Navarro, and 4 by thin majority in Congress. So I already knew that he would lash out, but they will have to chicken out. And I wrote extensively after April 2nd saying, in the game of chicken with the markets, with Powell and Xi Jinping, they want to blink and chicken out. The first one would be Trump, because otherwise, tightening of financial condition, recession, you lose the midterm, and then all your MAGA plans and goals are dead on arrival. And these people, whether you like them or not, are not irrational, and they're not stupid. So if they want to stay in power, they have to follow what the market discipline tells them. So I saw it coming. That's why I said, we're not going to have a US and global recession this year. So I ended up being out of consensus, a contrarian, but actually more optimistic than most people.
Well, and you're used to being out of consensus, so that probably wasn't an uncomfortable feeling for you.
Well, usually people say you're always more pessimistic than everybody. It's not true. When there was the Greek financial crisis, the consensus in Wall Street was there'll be Grexit. While I realized in the game of chicken between Greece and the Troika, the Greek will have to blink, and therefore there will not be Grexit, and there'll be geopolitical consequences of a Greek exit from the Eurozone. When in 2015 and 16, everybody said there'll be a Chinese hard landing because their stock market crashed. I said, no, China is the tool. It's not going to have soft landing. It's not going to have a hard landing. It's going to be a bumpy landing. And again, this time around, I've been more optimistic than consensus. So people think of me as being always more pessimistic than consensus, but actually, you follow closely what I say. On a number of occasions, I've been contrarian, but in ways in which the consensus actually was about doom and gloom. And I said, no, there'll be constraints to those things.
The interesting thing, too, is if we look back to your comments in 2006, kind of forecasting what became the global financial crisis, if we look at kind of what caused it, with hindsight, we're like, oh, of course that was going to happen. So it's amazing that so many people were shocked then. I mean, I guess it's hard to see where you're at when you're in the middle of it. But I think it's anyone looking back on what led to 2008 is like, oh, well, all the variables are pointing to yes.
Yes, absolutely. But, everybody's interest was essentially to continue this securitization game and then passing the hot potato down the line from the lenders to those who were securitizing it, to the mortgage insurance, to everybody else in that securitization chain, and knowing that maybe you could privatize the gains and socialize the losses. But, I'd spent a decade studying economic and financial crisis, both in theory in academia, doing empirical work, and then doing the policy work when I was in the White House and Treasury. So you have to understand economics, policy, and markets, the link between the three to understand what triggers, financial crisis. So it was not out of nowhere, just that I've been studying this stuff in all dimensions for over decades, and I became an expert of what drives them. So I saw it coming. Also because I didn't have conflicts of interest, Policymakers talk their books, people in the financial sector talk their book, and so on. And therefore, often the conventional wisdom is biased for a number of reasons.
In your opinion, which of these mega threats do you think the markets and or policymakers are most underestimating?
Well, there are many of them, but many of them are sort of course, considered and to some extent priced in. We have a geopolitical depression and war could happen. I think that people are now realizing to be in a stagflationary world with higher inflation and lower growth. We could have debt crisis, there's climate change, there's pandemics, you name it. But I would say that the one that paradoxically is still underappreciated are both the upside and the downsides coming from the artificial intelligence revolution. Because on one side, of course, it's going to change the world for the better, increasing potential growth over time. But I don't think people are fully recognizing the potential negative of it. One, of course, is a massive increase in misinformation, disinformation, deep fakes, malinformation, neg information, and manipulation of policies and election by bad actors, both domestic and foreign. Two, we'll have a massive increase in income and wealth inequality because these technologies are capital intensive, skill bias, and labor saving. So if you own the machines or the capital owns the machine, you're going to do well. If you're in the top, say, 10 to 20% distribution of skills, human capital, education, probably the AI is going to make you smarter. But everybody else, the rest of the 80%, blue collar, white collar, low, medium value added, their jobs and income are going to be threatened by AI, machine learning, robotic, automation, and you name it. Three, paradoxically, every technological revolution leads initially to developments of more deadly weapon system to fight more deadly wars. We built the tanks and the artillery that led to World War I. We built, the aircrafts and the more advanced artillery and aircraft carrier systems to fight World War II. And of course, before we had nuclear power, we had nuclear weapons. And unfortunately, to end World War II, the US used a nuclear bomb on Hiroshima and Nagasaki. So paradoxically, technological innovation are often initially started as military application, and then they have their own civilian spillovers. The internet started as a DARPA project. The jumbo jet started as a military cargo. And Israel being the startup nation, when you're in the army, there are all these tech applications and new developments, and then somebody finds the dual use and creates an app or a new technology that actually has both commercial, civilian, and military kind of application and so on. So AI is leading now to a complete change in the nature of warfare. Look at what's happening in Russia, Ukraine, where a $10,000 small drone can destroy a nuclear bomber or a $30 million tank. And therefore, the nature of warfare is going to become uglier. For now, it's only semi-autonomous drones, but eventually you'll have fully autonomous weapon systems, and you could even have robo-soldiers fighting wars. And if you're not going to kill people because the wars are fought by robo-soldiers, does it make warfare more prevalent? Probably yes, because what restrains warfare is the risk that people are going to die. And in democratic society, we're averse to war because we don't want to have a slaughter of our own children and brothers and sisters, and you name it. So that's another risk. And the other existential risk that some people worried that eventually with AGI and ASI, artificial superintelligence, the human race, Homo sapiens, is going to become obsolete. That either we find a way of merging with the machine, or eventually the machine is going to realize we're useless. They don't need us, and then they may get rid of us. I think if there's a tail risk is one that eventually either our species evolves into something else, or otherwise we could become extinct. So those are some of the threats coming from AI that I think are underappreciated yet, even if AI is a positive because of increased productivity and potential growth over time.
So in that vein, I think one thing that's interesting in the book is when you talk about the mega threats, A, a lot of them are interconnected, and B, a lot of them arose as one-time solutions to existing threats. So it's the unintended consequences that we kind of lose sight of.
You're absolutely right. We started doing unconventional monetary policy like zero or negative policy rates or QE because we had low inflation or even deflation. And then it became a monster with lots of other side consequences, including now, eventually after COVID, a burst of inflation. We built up private and public debt allegedly to finance investment in the future, but then a lot of it went not into investment, but consumption, and now you have a debt build-up that is unsustainable. And using excessively fiscal policy as a pro-cyclical kind of or counter-cyclical tool, again, leads to a build-up of debt. We have bailed out over and over again private actors of various sorts during crises because we were worried that liquidity is going to cause insolvency. But then we have created a moral hazard problem with privatizing the gains and socializing the losses, and leading to even more buildup of private and public debt and leverage and risk-taking. Climate change, on one side, we don't do enough about it. On the other side, I think many of the elements of the green transitions are problematic in many and different ways. Yes, sometimes good intention policies have unintended consequences that lead to other types of damage and risk that we don't consider. And as you pointed out, all these mega threats are related to each other. It's not just only economic or monetary or financial risk, but there's also social, political, geopolitical, environmental, health, demographic, technological. That's why when I speak about the 10 mega threats, I think of it as a matrix, 10 by 10, where each one of these threats affects the other one and vice versa. So in this world, you cannot anymore study this thing in silos. There are hundreds of books about climate change or geopolitics or about pandemics or about financial crisis or debt or you name it, but they're disconnected. What the book tries to do in a holistic way to see the connection between all these different factors.
And I do want to say, though, one thing that was interesting is there was a case for optimism in the book as well, and talking about high economic growth. So maybe that's a great time to transition and talk about some of your current work with Atlas.
Yes, at Atlas, we recognize what are these mega threats, where there is the risk of the mother of all debt crisis, private or public, the risk of inflation and stagflation, the risk of debasement of fiat currencies, the risk of eventual de-dollarization, the risk that this geopolitical depression is going to lead to more fragmentation of the world economy, with Cold Wars getting colder and then real hot wars like we see Russia, Ukraine, or in the Middle East, or between India and Pakistan, or the Cold War between US and China. Global climate change is a huge threat that absolutely has to be addressed. We have seen COVID-19, but this is not going to be the last one of pandemics and not the most virulent one. We have not only warfare, but the nature of warfare is different, as we saw in Russia, Ukraine, and increasingly cyber warfare is going to cause economic damage. You have a demographic boom in some parts of the world, and others there's aging and massive pressure to migrating from south to north, from poor to rich, because failed states that occur around the world lead then to mass migration. We have this backlash that is key against liberal democracy and democratic capitalism is driven, in my view, both by income and wealth inequality, but also by economic insecurity. People are worried about jobs, about their future, and whether their children are going to be as well off or better off than themselves. And then finally, as I said, AI can increase productivity growth and potential growth, but there are all these other negative side effects of it as well. So those are the kind of things I worry about. But I recognize in the book there are two chapters, one on AI, where I stress on how AI can increase productivity growth and potential growth. And there's a dystopian scenario where all these mega threats feed on each other. It's not just the end of the economy, it could be the end of the world, driven by climate change, by a nuclear war among great powers, and you name it. But there's also a utopian chapter where if you have the right technologies and use them right, whether it's AI, fusion, and others, and you have good policies and good leadership, maybe you can get into a virtual cycle where things are improve over time. And I think it's still a difficult balance. There are 10 mega threats, and there's only one force, in my view, that is going in the positive direction. Recently, I stressed some of the positives for the US specifically. I said in the US, tech trumps tariffs, because in the US, I see a country that is the technological leader in all these 14 different industries of the future. US is number one. China is ahead of US only in green tech, electric vehicles, and maybe batteries, but everything else is the US. So in the US, potential growth can go in the next few years from 2% to 4%, while tariffs and migration restriction may reduce growth only by 50 basis points. So on the positive, you have 200, on the negative, you have 50. But it's mostly a story for the US. Europe is stagnating. Many other parts of the world, advanced economies, are stagnating. Of course, many emerging markets are still very fragile. So I think there is a story you can tell about technology doing things better if you use it right, but not every country is going to innovate, and not every country is going to be able to adapt technologies in a way that increases growth. And eventually, technology is going to destroy most jobs. So if your potential growth is high, it goes from 2 to 4 to 6 in US, you can use the universal basic income to tax essentially the winners and redistribute to those who are left behind. But if you're a poor country that is in Africa or emerging markets, unless you have international UBI and you have transfer of income across countries, unlikely to happen, and you don't adapt, you don't innovate, you could be left behind. We're speaking about billions of people that may be in a world that becomes more fragile, that are left behind. And then there is failed states, and then you have mass migration, and there is violence, and there is terrorism, and lots of international spillovers coming from these things. So it's a mixed bag, the world. But definitely on the US, I see a story where over time, technology is going to definitely increase potential growth.
So I think that's really fascinating to dive into, because the very alliterative tech trumps tariffs, but calling for actual, you're thinking that's additive 200 basis points to growth up to 2030, by 2030?
Yeah, yes.
And even the tariff headwind, which is front and center more recently, where we've had it kind of hot and then off and then hot and then off, at most maybe detracts 50 basis points.
Yes. That's why I believe most likely we avoid a recession. But in the short run, unless there's a trade deal with Europe, USMCA, China, and main trading partners, there's still a risk of a recession this year. Short and shallow, but there is a risk of a recession. Might not be my baseline, but it is. But medium term, I think that the tailwinds coming from capex in AI are gonna, in the US, as I said, US is number one, China is a distant two, and everybody else, Europe is not even 4 or 5, it's number 7 or 8. So there are some pockets of excellence around the world, but US growth might accelerate. The Eurozone growth is potentially at 1% right now. It's going to stagnate around 1% because you don't have the innovation risk-taking in Europe that you have in the US. So Europe and Eurozone could go through a process of economic, financial, and even political disintegration rather than integration. So the risks are not just for emerging markets or frontier economy, but some of the advanced economies, unless they do structural reform and they increase their potential growth, they could stagnate. But as Hemingway once said, he said, how you go bankrupt? He said, initially slowly and then suddenly. And I wrote a whole book about financial crisis in emerging market, where exactly that's what happens. Initially, things are moving sideways, you're stagnating, and then there's a sudden crash.
I use that quote a lot. That was from The Sun Also Rises, which is one of probably my favorite Hemingway book.
Yeah.
Slowly at first, and then suddenly.
Yeah.
Given that environment, you co-founded Atlas Capital to apply this macro framework to the markets. One of the concepts as we were getting to know each other that really stood out to us was just a simple one, which was your 3 C's: credit, commodities, and communities, and how they're the pillars of national prosperity. Maybe expand upon that a little bit more for the listeners.
Yes. Well, we start initially from the 3 W's that are wealth, weather, and war, because you need to preserve your wealth. And in this environment, it's harder to preserve your wealth. 2, weather and climate change can have massive disruptive effects. And 3, wars and geopolitics can be disruptive. And then we're thinking about what are the assets that can essentially shelter you. But before you get to the asset allocation, I think the way to think about what we do is as follows. Suppose we're in a world in which there is a risk of inflation, stagflation, debasement of fiat currencies, debt crisis, potential de-dollarization, climate change, and other things that increase inflation. And then how you protect yourself and what's the right defensive asset. If you think about it, we're not predicting doom and gloom. We're not saying that you'll have hyperinflation in the US or even high inflation. I don't even believe that we're going to have a double-digit inflation like we had in the 70s, meaning more than 10%. But suppose that the average inflation rate in the US that right now is 3%, instead of being 3%, is 6%. It's really very, very mild assumption. And given that each one of these mega threats increases cost, wages, prices, and inflation, each one of them is stagflationary, thinking that the average inflation rate is going to be 6 rather than 3 in the next few years, I'm not saying tomorrow, is not far-fetched at all. So really, it's a very modest prediction, not even 10, let alone 100 or higher, from 3 to 6 average. 10-year bonds today are 4.5%, and they're the traditional defensive asset. But in a world where inflation is 6, 10-year yields cannot be 4.5. They have to be at least 8%, 6 for expected inflation and 2 real, because the real rate now, long real rate is about 2. Now, it looks like a small change, but in 2022, when 10-year Treasury went from, say, 1% to 3.5%, as you had inflation and the Fed was tightening, S&P fell that year by 15%, but the price of 10-year Treasury fell by 20%, because as you know, there's an inverse relation between the yield and the price. So historically, what's the defensive asset? Is long duration Treasury, say 60-40 portfolio, 70-30, even the fancy Bridgewater risk parity. And the logic is that there is a negative correlation between the price of equities and the price of bonds. If you have economic growth and risk on, equity go higher, but bond yields are also higher, the price of bond is lower, you make money on the equity side of your 60-40, you lose money on the bond side of your portfolio. If there is risk off or as a recession, equity prices are falling, but bond yields are falling and their prices going higher. So you lose money on equities, but you make money on bonds. That's the logic of the traditional asset allocation, where long duration fixed income Treasury, 10 years or whatever, is the defensive asset. And by the way, there are over $20 trillion in the world of dollar long duration Treasuries, let alone high yield, high grade, and then EM debt that is in dollar. So, but what happens is that that correlation is negative, assumes that inflation is low, 2%. When inflation is high and rising, what happens? Bond yields are higher because they have to be higher for expected inflation. So higher bond yield means the price is lower. So you lose money on bonds. But higher bond yields imply, like 2022, that then the discount factor for those dividends or profit is greater, and therefore you have a correction of equities. And in 2022, S&P fell by 15. The NASDAQ fell by more than 20. Growth stocks and tech stock fell by 30, 40, because they're long duration assets, and therefore they are more sensitive to interest rates. So instead of having a negative correlation, you had a positive correlation, and that year you lost money on treasuries and you lost money on equities. So it was a balanced bear. It was not just 22. It happened again when you had these shocks to bond yields in 23, 24. And look at the last 6 months. The last 6 months, bond yields have gone from 3.8 to 4.5, and equities have fallen. Now they've recovered a little bit. But effectively, if you had a 60-40 portfolio from, say, the election until now, you lost money, while our portfolio has made money rather than losing money. So the main critical point is that the traditional defensive asset, that is long duration fixed income, doesn't work anymore when you have even mild inflation, literally going from 3 to 6, let alone much higher than that. You lose money on bonds, you lose money on equity. So the whole logic of creating this USAF ETF, that is the Atlas ETF, is what are alternative assets that can do well when you have inflation, debasement of fiat currency, risk of de-dollarization, geopolitical shock, environmental shock. And we create a portfolio of assets that actually can be too defensive in the state of the world of mild, really mild stagflationary pressure. Again, it's not doom and gloom. It's a world where if inflation is at 6, you're going to have a bloodbath on equities and on bonds. That's what we've designed, and has done very well, even in the last 6 months since inception.
So your portfolio, if we can talk about some of the asset classes, if traditional defensive assets, so we look at long-term treasuries, for instance, are no longer working because they have a positive correlation in the inflationary environment, what are you looking at in the portfolio and how are you structuring it?
Well, it's a combination of various different asset classes do well in this tail risk. First, instead of having long duration treasuries, you want to have short-term treasuries where if bond yields are higher, the yield is higher, but the price action is smaller because with short duration, you don't have the same price impact with rising yield than you do with long duration. Two, you want to have tips. Tips are, inflation index bonds. They're going to do well if actual and expected inflation is going higher. Three, we want to be overweight in gold. Gold does well when there is inflation in the basement. Gold does well when you have a financial crisis where your money in the bank is not safe and maybe you want to have gold in a mattress or in a lockbox. Gold does well when there is the risk of geopolitical tensions. One of the reasons why gold has gone up 40% last year is that after Russia-Ukraine, we know that if there is a tension between US and its rivals, you're going to see dollar, euro, yen, pound, Swiss francs. What is the only global liquid reserve asset? It's not the currency anymore that cannot be seized by the West if there's a conflict with China or another rival, is a gold bullion, literally bullion, that you keep, of course, in the basement of the PBOC, not in the basement of the New York Fed. So gold has done well. We believe that in the world of climate change, ag commodities are going to do well because climate change leads to lack of water, desertification, collapse of agriculture, and demand is high. This will be a world in which there are 8 billion people, eventually 10. So demand is going to grow. Everybody has to eat. That's the basics. But supply is not going to grow fast enough because of climate change. It's a world where historically real estate actually does reasonably well when there is moderate inflation because rent can be adjusted and land and buildings are in the short term in fixed supply. So equities do poorly, but actually real estate with moderate inflation tends to do well. The problem is that if you look at even in North America, there'll be trillions of dollars of real estate that's going to be stranded because of climate change, either flooding, hurricanes, droughts, wildfires, and you name it. So we have a map using data at the level of individual counties. It's using a sophisticated big data AI model that looks at every REIT in North America, the US and Canada, looks at each one of their properties and looks at in which zip code they are. And we are measuring using really very, very sophisticated AI and big data that we have through various sources. What's the risk of damage to real estate, commercial, residential, infrastructure coming from climate change? So we overweight the parts of the US are going to be doing well with climate change, mostly Midwest, underweight coastlines in the South, where those climate change is going to be occurring. So yes, real estate, but sustainable kind of real estate. So and then we have an overlay of macro hedges to deal with a variety of other tail risk. And it's a sophisticated quant model because the returns on these assets do well, but depends on the state of the world. Are you with high or low growth? Are you with high or low inflation? Is growth and inflation accelerating or decelerating? So we have a 4-to-4 matrix, 16 states of the world about growth and inflation. And historically, the returns of these different asset classes are different depending on whether you're in a boom or you're in a stagflation or inflation is rising or is falling. So it's a very quantitative approach to addressing what are the states of the world, what are the climate risk, what are the geopolitical risk, and therefore how you do an allocation between short-term treasuries, tips, gold, ag, commodities, and sustainable real estate, and some macro hedges and overlay to deal with this variety of risks. And since inception, this has done better than S&P 500, has done better than 60-40, has done better than 10-year Treasury, has done better pretty much than any other comparable, is better than all-weather funds of various sorts. And it's only 6 months since launch, but we're actually proud of what has already been the results. Meaning what we said has turned out to be actually correct. And this has had really positive middle-digit returns where everything else has been into negative or close to negative.
And so that's interesting when we're thinking about reframing the defensive part of a portfolio. This portfolio in particular is not about predicting, a single binary event, but it's about adapting to many.
Yes. The risk could be inflation, debasement of fiat currency, political risk, geopolitical risk, environmental risk, risk of de-dollarization, if rather the US try to get out of dollar assets as we weaponize the dollar, combination of things that can happen that are tail risk. And the correlation between many of these assets is negative. So when some do better, some can do worse, and vice versa. So it's a very diversified approach and considers both states of the world, considers geopolitical risk that we measure both in a quantitative and a qualitative way, considers that real estate has to be adjusted to investment in parts of North America that are resilient and sustainable. So it's a pretty complex and sophisticated, mostly quantitative approach to portfolio diversification, to risk diversification, and to hedge against a variety of the type of risk that we have addressed that come out of my Megathreats book. But people told me, put your money where your mouth is, otherwise it's all theory. So I try to figure out how we can then address the risk in a way that protects investors from the kind of risks that are going to be emerging, and they're already emerging now.
Absolutely, from academia to forming policy to now, actually being responsible for a portfolio and investors' money. It's a fascinating career arc, and I'm sure it's been a lot of fun for you as well.
Definitely. That's an arc from academic economists to policymaker to advisors of hedge funds and other investors, but now not only talking about money, but then trying to manage money. And of course, it's a challenge. It's a different. One thing is talk about money, one is managing it. But it's a fascinating kind of challenge to see the connection between your ideas and what a portfolio could be and should be.
Well, that's a great segue, and a lot of our audience is made up of financial advisors. So maybe we speak directly to them for a second. What do they need to be thinking about, in your opinion, over the next 6 to 12 months in terms of everything that we've kind of rolled out, and maybe how your portfolio at USAF might play a role?
Well, I wrote the book late 22, but everything I wrote about has become even more relevant today. And, in the re-election of Donald Trump, some of his policy may increase growth, but some of them may cause higher inflation. We know it's a mixed bag, and we'll see in which direction they go. But literally, I would say the re-election of Trump, and it's not just Trump, what's happening geopolitically around the world, suggests that some of the concerns in the books are as relevant today as they are. And I would say the following thing, you may not fully believe, you always have to do a scenario analysis. You have a baseline, you have an upside scenario, downside. Now, suppose that you're not convinced that in the next few years, inflation, US and global, is going to go from 3 to 6%. You don't think is your baseline. But suppose even that you had a probability of 20% or 30 or 40, whatever your subjective probability that this scenario is going to materialize. If you're an advisor and you tell your investor do 60-40, and then even is a 30% probability of what I'm saying happening, then if what we say happens and you're 60-40 or any variance of it, it's going to be a bloodbath. They're going to lose on equities and they're going to lose on bonds. And on equities, actually, everybody's overinvested in tech and into NASDAQ, into Mag 7, hyperscalers. But as we saw in 2022, tech stocks and growth stocks are more sensitive to changes in long rates because they're long duration assets where most of the profit dividends are farther in the future. So S&P went down by 15 in 22, NASDAQ went down by 30, many tech and growth stocks went down by 50, 60%. So even if you believe in the long-term story, and I do, about technology being important, you can have really massive losses. So if your traditional advice is, go into mostly equities and maybe NASDAQ or tech stuff and Mag 7, and then maybe hedge yourself by having some ratio of what you do into stuff that's defensive, and here is a 10-year Treasury, it's very risky. Even if you don't believe fully my view, even if it's only 40% probability, 30, some of your defensive component should not be long-term Treasuries. Now, in our Atlas fund, there is zero long-term Treasuries because we have a conviction that they're not going to do well for lots of reasons. But even if your conviction is not as strong as ours, even if it's only 30% probability, you should put some fraction of your defensive part of your portfolio into something like Atlas. Because if you don't do it, and then what happens, you'll have the balance bear that you got in 2022, you had in the summer of 23, you had in the summer of 24, and we had that same balance bear on equity and bonds since November of last year. So it's really material risk has happened 4 times in the last literally 3 years. So you cannot ignore it. It's not just theory. It's happening right now. So you'll be actually, I would say, almost reckless to not warn your clients that there are these risks, and then you have to find a better hedge than the traditional long-term Treasury defensive asset. It doesn't work.
And that's the one thing an advisor can really control. You know, nobody can control returns, but you can control risk in a portfolio and where you're sourcing it from. So I think from a portfolio construction standpoint, that's important. If we put your economist hat back on, you know, I think one thing we spoke about earlier when you and I were on the phone was talking about making your base case, but there's variables that impact that base case. So it's being aware of those variables and trying to manage within those lines.
Yeah. Your base case for some people might still be inflation at 2 or 3. That's your baseline. But then you're thinking about the world in which inflation is going to be 5, 6 or more. And of course, there could be even a world where technology leads us to good deflation over the long term. But that's going to take a long time. And what I'm saying is, even if your baseline is still 2-3% inflation, but the downside scenario is a 6% inflation, that is my baseline, then whatever probability you assign to that tail scenario, some of your portfolio advice should be consistent with that. Because even if it's only a third probability, and you do traditional 60-40, you're going to lose money across the board, literally across the board. And everybody's all over-invested, of course, into tech, because that's the future. But as I pointed out, that's the one that is most sensitive to long rates, as we saw in the last few years. So even if you believe in the long-term story, then bouts of shocks to long rates are things that you have to hedge yourself. And long rates is not the way to hedge yourself. You have to stay away from that stuff.
Definitely. I think that gives our audience a lot to think about, too, when they look at their own portfolios that they're managing for their clients.
Yes. And that's what we're trying to do. And we've created really, I mean, some people say I can buy only tips or short-term Treasury. It's not that mechanical because you have inflation, you have de-dollarization, you have climate change, the political risk, the geopolitical risk. And each one of these different components of the Atlas ETF is concerned about the very different types of tail risk and how they're correlated with each other. And depends, as I said, the state of the world. There are 16 states of the world. And real estate has to be resilient because climate change is going to strand trillions of dollars of real estate. And you have to have a layer of understanding in a sophisticated way what kind of geopolitical risk are going to materialize and what's their market impact. So some people say, let me be overweight just in gold. You know, gold is going to do well, but you don't want to be just in gold. You have to be having a very comprehensive, holistic approach to risk, return, portfolio diversification to create a sophisticated, defensive asset. And that's exactly what it is. It's not a replacement for your entire portfolio. You can decide how much you're comfortable with equities and growth equities and tech equities. We're not talking about that. We're asking yourself, the part of your portfolio that is defensive, how you can make sure that actually it doesn't do poorly when equity are going to do poorly. And that's, you have to focus on that one. And it's done in a way that is very complex and very sophisticated and quantitative, with also a variety of qualitative assessment and hedges and macro overlays. And it took us years to develop. It's not something you just do overnight by buying gold or tips. It's much more complicated than that.
So when you think about the clients, what do you think, and again, going back to our audience and speaking to the advisor, what is the best way in your mind to frame the macro uncertainty without stoking fear? Like, what's the right level of realism and reassurance?
Well, realism is to say the world is not going to end. We're not going to end up with hyperinflation, but we could be in a world in which highly likely inflation is not 3, but is 6. As I said, I'm not talking about even 10, let alone hyperinflation. I think that if you look at the variety of things, JP Morgan, Goldman are talking about a variety of the same risk and why inflation could end up at 6. We may have to debase fiat currency and having higher inflation to wipe out the real value of long duration fixed income. That's what happened in 2022. So you don't have to be doom and gloom. Just saying realistically, a world where inflation is at 6 rather than 3 is not a world of disaster, but the world is realistic. And we were at 6 or 9 already, in 2022. And 2022 was a bloodbath for equities, it was a bloodbath for bond, it was a bloodbath for almost everything. And those kind of things are going to happen again. It happened in 22 and happened again the last 6 months, happened in episodes in the summer 23 and 24. So it's not being doom and gloomy. It's being realistic about the fact that even a mild, materialization of some tail risk can push you in a world where bond yields are much higher and you're going to lose money on bonds and on equities. And you have to be cautious. And being cautious means to think about something else. It's as simple as that. It's not really being scaring anybody. It's actually telling people mild risk have actually significant financial consequence. And mild risk means inflation at 6 rather than 3. That's what we're saying, inflation at 6.
All right. Well, Dr. Roubini, I know we've taken a lot of your time, but I did want to wrap up with a little different segment in the podcast where we ask kind of a rapid fire question, and maybe we can get less from the doom and gloom and think about more of the personal side of it. So we're not talking about mega threats, but one thing I think I'd be interested to know is, you've called yourself in the past a global nomad. So in that vein, what would be your favorite country to visit?
I visited already maybe 100 countries out of the 200 in the world, and even a little small island somewhere can be interesting. So I'm not a snob. I'm curious. So wherever I go, I want to know the people, the culture, the food, their history, their politics. I think any society is interesting. I grew up in Italy, and I've been in Italy over and over again forever. But, there's still parts of Italy and small islands and beaches I've never been. And, some places have nature, but they don't have art and culture. Some places have art and culture, but don't have great nature. Some places don't have great food. In Italy, you have art, culture, music, history, architecture, great food, style, design, great nature. You have beaches, you have mountains, you have lakes, you have hills, you have a bit of everything. So Italy is definitely still, even if I spent 20 years there where I often vacation. I would say there's one country I went recently, it's fascinating, that no one knows about. The country is called the happiest country in the world, that created the concept of gross national happiness. Instead of maximizing GNP, they maximize GNH. It's Bhutan. It's a landlocked country between India, Nepal, and China. So it's literally is the happiness country. It's a fascinating country. Zen Buddhist across the border from Tibet in Bhutan. So if you want to go to a very exotic place where the time warp, you feel like you're back into the 16th century, go to Bhutan. Shangri-La used to be Tibet, but then the Chinese Han colonized it and destroyed the local culture. While across the border, there's Bhutan, that is the new Shangri-La. So if you have already been to Italy, go to Bhutan.
All right. Well, they say there's no place like home. So, of course, it'd be Italy, but Bhutan, I'll put on the list.
Yeah. Should be on your bucket list.
If you were to pick one trend right now that gives you the most optimism, what is it?
Well, it's technology. I think that AI and all these other technologies of the future. By the way, it's not just AI, it's not machine learning, it's not just robotic, it's quantum, it's fusion, it's defense tech, it's biomedical research, it's fintech, agtech, new material science, new cryptography. I mean, there are about a dozen different industries of future, all affected by AI, going to change the way the world works. In some ways for the better, in some ways scary. Scary because it could lead to more war, to more misinformation, to more income and wealth inequality, to more even risk of existential threat to Homo sapiens. So we have to manage it. If we manage it right, it'll be a better world. If we don't manage it right, it can become a Frankenstein monster. But AI is the thing that AI and broadly all these technologies of the future, that's what gives me hope that maybe we eventually end up, if we can navigate these mega threats, there are 10 of them in the short, medium term, maybe 10 to 20 years from now, there'll be a brighter future where AI is going to make things better. But it's going to be very bumpy and stormy. Be a storm before hopefully the AI calm is going to come. It's not going to be overnight. And the next 10, 20 years, you have to really worry more about the mega threats than the nirvana of a world where technology makes everybody better off.
So last one, and then we'll let you go. I know your time's very valuable. But what I'd be interested in knowing is how do you reset when you're taking time away from the macro world? Is there any particular thing you like to do to take your mind off things?
Well, I travel all the time, and usually weekdays are busy with work. So I was just for a week in Brazil. I came back literally Monday morning. So from Monday until Friday, I was in São Paulo for business meeting, policy meetings, you name it. And then instead of rushing back to New York on Friday, I said, I'm going to take a flight to Rio, spend the weekend in Rio. The weather was in the 70s, nice and warm, great beaches, great food. It's a beautiful city. So, I like a little bit of nature. I like art and culture. If I go to a place, I go to the museums, I see the local art. I'm a foodie, and I love the food locally. If I go to Brazil, I want to have Brazilian food. So, some combination of leisure, being in nature, great cities, art, culture, food, and very interesting people everywhere you can meet. So, relax for the weekend before you start again a busy weekday.
Oh, that's great. That's a great answer. I appreciate that. Well, I think we definitely appreciate your time. That's all we have, and I want to make sure you can get back to doing, the work you're doing with Atlas, and I'm sure you have a stacked day today. But definitely appreciate it, Dr. Roubini.
Thanks very much for having me and giving the opportunity to speak about my views and also about Atlas and what we do.
No, it was great having you on, and we look forward to continuing the partnership.
Great pleasure. Thanks again.
Take care.
Right. Thank you. Talk soon.
Okay, bye.
And that's a wrap for today's episode of In the Harbor. A big thank you to Dr. Nouriel Roubini for joining us and sharing his insights on everything from global megathreats to the surprising case for 4% growth by 2030.
From policies to portfolios, this conversation really brought together the macro and the micro, reminding us that clients don't just need performance, they need perspective.
Exactly. And whether you're managing risk in today's uncertain environment or positioning for the next wave of innovation, the key is staying grounded in frameworks that work in the real world.
If today's episode got you thinking, check out the work of Dr. Roubini at Atlas Capital, which is built around many of the themes that we discussed today.
Thanks for tuning in. Be sure to subscribe, like, share, and drop us a line if there's a topic or guest you'd like us to cover next. We'll see you next time in the Harbor.